A very big welcome to all of you, our esteemed listeners and participants today. Depending on which part of the world that you are in, it could be good morning, good afternoon, or evening. Currently, I'm in Ghana, and it's good afternoon, it's 12 o'clock. And I believe in the UK, it's also 12 o'clock. This webinar should have taken place some time back, but there were bits of some circumstances beyond our control. But by God's grace, we'll be able to get it running. And today, we are going to be benefiting from it. Mining taxation and revenue management is a very important issue facing most resource-rich countries. And these involve decisions such as which fiscal instruments to use. Is the investor being taxed too much or too little? Or it could even border around issues of governance and then revenue management. These are some of the issues that are going to be addressed in line with the main issues that were highlighted on the flyer. My name is Kofi Chimampofu Agri, and I'm a policy planning officer at the Minerals Commission of Ghana. I just completed my master's degree in international mineral resource management from the University of Dundee, and I'm humbled to be moderating this webinar. This event is being organized by the Extractive Hub, a research organization that supports policymakers with relevant, up-to-date information. And the Extractive Hub is based in the University of Dundee. The recorded video will be made available on the Hub website, so I'd encourage all of you to please go and check out the website if you missed this video because of work or some other meetings. Professor Philip Daniel is a specialist on resource-rich economies, notably for oil, gas, and mining taxation. He's an economist with degrees from the University of Oxford, Cambridge, and East Anglia. He has experience in macroeconomics and fiscal policy, tax policy, contract negotiations, just to mention a few. He has worked with the Fiscal Affairs Department of the IMF in Washington for 9 years until retiring in 2015, where he served as the deputy head of tax policy division and subsequently an advisor in the front office. He has worked all over the world in about 25 countries, mostly as a mission head and the chair of the advisory board for the Oxford Center for Analysis of the Resource-Rich Economies at the Department of Economics, University of Oxford. He's going to be making a presentation of about 25 to 30 minutes, then after we delve into questions and answers. So without wasting so much time again, I'd give the floor to Professor Philip Daniel to start his presentation. Professor Philip Daniel, please, over to you.
Thank you, Kofi. Thank you, Victoria. As I said, my name is Philip Daniel. I'm fortunate to be an honorary professor at Dundee and to have taught modules in the master's degrees a number of times. So this morning, I'll concentrate on fiscal regimes for extractive industries. There'll be some mention of the revenue management questions, but in a short presentation, it's of course not straightforward to cover absolutely everything. Let's look at what is sometimes said about fiscal regimes. This is from the Natural Resource Charter, that tax regimes and contractual terms should enable the government to realize the full value of its resources, consistent with attracting necessary investment, and should be robust to changing circumstances. Well, perhaps for today, instead of having that as a statement, we can change it into a question. And 4 questions were asked on the flyer. Does the resource rent in mining actually exist, and how can it be taxed effectively? Should the critical mineral industry be taxed differently? What is the right balance in the terms of fiscal regimes, which is a win-win for both government and investor in the mining sector? And lastly, should mining royalties be scrapped? Is this a tax or a charge? Well, I'm not going to try one by one to address those questions, but to give some thoughts from my perspective, which might help us to go that way. First of all, what are we talking about when we say we have a fiscal regime? Well, I take it as a system combining tax and non-tax instruments to raise government revenue from resource extraction. The fiscal regime includes instruments such as royalty and corporate income tax, as well as contractual schemes such as production sharing agreements or contracts. It can also include elements of state participation with a fiscal effect on the division of revenues, even when those shares are held by a commercially operating state-owned enterprise. The fiscal regime may also include taxes, fees, levies, and charges which accrue to the state by way of additions to input costs. Now, extractive industry revenues are well known as a key source of revenue for many developing countries. Here's a chart which will be on the recording prepared by my colleagues at the International Monetary Fund, where in blue you see the percent of GDP in resource revenue for a wide range of countries, and the circular dots represent totals. In one case, percentage total revenue excluding grants from 2000 to 2013, and then updating it to 2016. We can see that evidently the resource revenues are very large. Now, clearly, we'll find a large portion of that is actually from petroleum rather than minerals. We asked the question, why are there distinct fiscal regimes for extractive industries? Well, that depends really on the characteristics of the sector. And the first characteristic I want to introduce is substantial rents. Now, that means rents in excess of a return in excess of project costs, including the minimum required by any investor. Now, you see this put out crudely in this chart, where you have production costs and price on the y-axis and cumulative production, or if you like, different projects on the x-axis. And along the hatched line at the top in blue, you see a long-term expected price. Now, clearly, costs differ among projects. You look at project F, and it's clearly not viable at the long-term price. The green ones, A to E, seem to be viable. And the gray area, therefore, represents what in this sort of definition we might call rent. But of course, this is very controversial because it depends what you include in the costs. Do you include in the costs the cost potentially of extracting now rather than in future? Do you include all the external environmental costs, the social disruption of the project? Would, in fact, you need to include a fee for extracting the resource, either in the green area or in the gray area? Those are many of the arguments that occur in this area. So it's not good to interpret this graph too literally. Now, the second characteristic I want to introduce is pervasive uncertainty. We live in times when that uncertainty is extraordinary, right at the moment. That's gold on the left, where you can see the very obvious fluctuations in price. And on the right, you have iron ore price graph, both the spot price and forecasts. Now, one of the purposes of putting this up like this is that the black line, and therefore the volatility of prices, is very well known to everybody, and I'm sure everybody attending this seminar. What is less well known is really how bad we are at forecasting what the price might be, because the dotted red lines in each case show what people thought the price would be in the month concerned, if you forecast ahead. And what you'll see almost always in the case of the gold price, and it will be the same when we come to oil later, was that forecasters thought the present price was the best predictor of the future price. That wasn't quite true for iron ore because people thought the market was diminishing, which in fact it did not over the very long term. These forecasts were also prepared by my colleagues at the IMF, and they shouldn't be blamed for what they say. Because for most forecasters, the place you start is the forward price on a market, whether it's a London Metal Exchange, the NYMEX, or whatever. And you start from that. So the red lines to begin with are the summary of what market actors thought the price would be. And only then do you project forward. The lesson is that to organize our fiscal regime around a range of prices or around a forecast of prices is almost certainly going to mean that the fiscal regime doesn't hit the target. Now, the same is true to a significant extent of costs. And here on the left-hand side is a capital cost index prepared by IHS Markit, and on the right, an operating cost index for the oil industry. And you'll see the volatility too there. We haven't laid one over the other, but it is fairly obvious that costs with a lag do tend to some extent to follow prices. And that's not surprising, because when the price is high, the demand for new exploration equipment and for new investment tends to be higher than when prices are low. But the point is that both costs and prices do fluctuate, though not necessarily in line, and the fluctuation in costs seems to be rather less. Let's just look at oil, and here's the same sort of graph with the potential forecasts and the fluctuation of prices. And you'll see pretty much the same phenomenon as you saw for gold. So probably best not to rely on a forecast of prices in setting the fiscal regime. Obviously, for budgetary purposes, some sort of forecast has to be made, but it should include, I think, some sort of doomsday possibility. In other words, a stress test. How well will we do if the price achieved is actually much lower than the price people were forecasting at the time we put the budget together? Now, the next characteristic of fiscal regimes that I can describe would be the requirement for very large upfront capital investment and the long production periods. And here you can see that in a stylized form with your negative capital cash flows over to the left in years 1 and 2, and typically in a large oil or mining project, a period of going up to a peak and then gradually declining down to the point when expenditure again is needed on decommissioning. Now, I emphasize this is stylized, it's not any particular project, and in many cases the production profile will be smoother. And particularly if you're a producer of natural gas, it is the market demand for the product that will determine the output rather than the technical factors, as long as there is reserve. So a gas profile will be considerably flatter. Now, if we continue along this line, we've dealt with substantial rents and pervasive uncertainty. We now have what I would call, and what economists call, asymmetric information. And if we take this together with the next one, which we've discussed, the high sunk costs and the long production period, we get the core problem of dealing with mining and petroleum projects. Let's suppose we start out and we are a small country with relatively little knowledge of our resources, and a big company, let's call it Top Mobile or something, comes in and says, I want to explore. The government rubs its hands and says, what a wonderful idea. What do we need to do to get you in? Well, the company says, well, you're very untried and untested territory, so we need the most generous possible terms. And the government says, well, that doesn't sound good to me, but we really want your investment in here. And since we don't know any better, we'll give you what you ask for. So a contract gets made, it's generous to the companies, the government didn't really know. Then what happens, as we saw, the very high sunk costs go in and there are long production periods. Once the capital has gone in and production starts, it's possible then that the project proves to be hugely profitable. The government says, hello, this was not fair. I didn't understand that this was what was going to happen, and you didn't tell me, and we're not getting enough. So what the government thinks is wise to do then, and in the public interest, is different now from what the government thought at the beginning. And that's what we call a problem of time inconsistency in government policy making. At one time, it appears right to give generous terms. At a point later, it appeared quite wrong. And so the government went in for renegotiation or nationalization or something of that sort. Now, if people expect that to happen, then there's going to be a difficulty about making investments in the first place, what we call the hold-up problem. Because if investors, whatever they are and wherever they come from, if they expect the government is going to change the terms, they will be more reluctant to commit the capital. So we need, and this is a core issue in fiscal regimes, we need some part of the framework which ensures flexibility and some kind of adjustment in the face of changing circumstances, so that there is an assurance for both parties that they can predict better what will happen in any circumstance. But if the circumstances are not what are expected, then it's possible that the effect of the regime will change, but change in a predictable way. Otherwise, you get very much into the business of making legal stability provisions, which are difficult to enforce and produce eventually quite a lot of potential litigation. Now, I'd add here that we also deal with a special situation in the extractive industries, that we have two things working in rather different directions. We have very extensive involvement of multinational corporations owned by private investors, investing in some countries. You all know the large multinationals in oil and mining, and of big state-owned enterprises in others. Now, the sector is dominated by certain multinationals, whether publicly traded or state-owned, and there are big state-owned corporations that invest internationally. In 2011, 6 of the 10 largest companies in the world by market capitalization were in the extractive industries business. And even after the huge growth of the data companies, the two extractives companies remained in the top 15. On the other hand, between 2/3 and 3/4 of world oil production comes from national oil companies owned by the state, and the proportion of reserves controlled by national oil companies is even higher. Now, this has a lot of implications, and like everything else we've discussed, it's all really political economy, not just economics, because the huge involvement of multinational corporations from private investors raises big issues about state sovereignty and the role of government, potential resource nationalism. On the other hand, the big involvement of the state-owned companies may improve the perception that there is much better state sovereignty over the resources, but it also, as we know, in many cases, introduces serious inefficiencies and possibilities of corruption. So these two things work in rather different directions, and they are a hugely complicating factor in, as it were, the management of capital flows in the natural resource industries, and thus in the design of the fiscal regime. Now, all of these things we've already talked about are not exclusive to extractive industries. And we can think of a lot of others: telecommunications, digital companies, on a smaller scale and regionally, even retail distribution. But what really is unique is the idea of exhaustibility. Now, this obviously originates from the idea that any particular resource in the ground can be mined out and will be exhausted. It's not really quite as simple as that. Obviously, if you've got one single mine locally, there will come a time when it is exhausted, and that's understood, and the local impact of exhaustion is very, very big. It's also conceivable, and this happened in Yemen with partly what you see as the awful political consequences, that countrywide the oil effectively ran out. And that can happen. But on a world scale, are we really looking at exhaustion? And I think the evidence suggests that we're not, except in a very limited and abstract sense. Because if you examine the records of reserve growth, as published, for example, by BP or the Energy Agency or others, you will find that for most minerals, the volume of exploitable reserves has tended over the last couple of decades actually to go up because of technological advances, improvements in demand, and thus a rise in prices, making more resources viable. So how important really is that? It's, of course, now especially important for a different reason, because we consider especially petroleum, but also minerals, as a vital matter in global warming and the issue of climate change. So there's a sense in which, on the one hand, oil and gas might become more exhaustible because the world decides they're not desirable commodities. And on the other hand, we have certain types of minerals, copper is within them, gold is within them, and many specialty minerals are within them, for which the demand is now accelerating very fast because they are important in renewable resources industries. But there's one key thing with all this, and this affects the revenue management. Whatever we have to say about exhaustibility, we do need to realize that if we are mining or extracting oil, we are transforming finite assets in the ground into other assets, whether those are simply financial assets and saved or immediately converted into social and physical infrastructure. So that's the key problem in the end in revenue management. So against all this background, what should we be aiming at in the fiscal regime? Well, I would suggest we want to maximize the present value, that's the value over time of our government revenues from these resources from all the different projects. Now, that clearly means we are balancing the incentive for people to commit capital with what we get from each individual resource. I know that people will argue there are other objectives, and clearly there are. Some of them are mitigation of negative consequences, like the environment, damage to population, and so on. But if we are taxing in a way that maximizes the present value of government revenues, remember, we will then have the financial resources to mitigate the damage. We may want to make a decision for all sorts of reasons to keep the resource in the ground. And the fiscal regime is one way in which we can decide to do that. We have to manage the risk and reward allocation between the governments and the multinational enterprises and banks that provide capital. The government will have a view on its preferred timing of receipts. Does it want more sooner and then may get less overall, or is it preferred? Is it willing to accept some deferral so that the receipts over the long term are maximized? it probably will want not just a predictable government take in the sense of making it flat over time, but a predictable government take across a range of outcomes. In other words, you make it possible to calculate what may happen in different circumstances. Now, progressive instruments, as they're called, which takes more as the profitability go up, will balance regressive instruments like royalty, which take less as the profitability goes up. But the more there is progressivity overall, the more risk the government is taking, because the more you take a high amount in good times, then the quicker will be the fall in bad times. Clearly, we want to provide for ease of administration for the authorities and, importantly, ease of compliance for taxpayers. Now, there are three main types of fiscal schemes, which are sometimes blended. First of all, contractual. That means that the government is enabled or enables a national corporation to make a contract. It gives that corporation the rights, and the corporation then makes contracts for other private agencies to undertake the work, and those could be production sharing or service contracts. Then originally, of course, we relied purely on a royalty, the fee to the king who owned the resource, or the queen, and charged normal business tax on the remainder with a licensing of areas. That's sometimes called a concessional system. I don't greatly like the word concession, because in the modern world, even under this regime without a contractual, the government is never giving anything away absolutely. It is only providing use for a period of time. So the term concession can be a bit provocative, and I think not accurately reflecting the situation. And then, of course, we will bring in the element of direct state ownership or participation. Now, in most countries of the world, the United States is to some extent an exception, the state owns the resources in the ground, but it doesn't necessarily own the productive machinery above the ground. And what state ownership or participation usually means is that the government or its corporation takes some kind of venture interest in the productive assets. Now, all these types of schemes can be made fiscally equivalent. In other words, you can do the same thing in terms of the division of rewards under each one. And I've written about that in a published article. What we need to do is design to achieve efficiency and transparency in each case. Well, what are the instruments? There's the possibility of a bonus, very common in the petroleum industry and has to some extent been common in mining, where a rehabilitation of an area is involved. In petroleum, it's best combined with bidding. In other words, it's a kind of auction for access to the resources. Then, almost universally, there is a royalty, some kind of fixed charge for the right to access the resource in the ground. Historically, this was an amount per unit of output, per ton or per pound, and recognized a direct payment to the resource owner. Now, the term royalty, again, has got a bit altered over time, and particularly in federal states, you have systems of royalty that are much closer to being taxes, because there is the ability to deduct costs. When I talk about a royalty here, I don't really refer to those. I refer to a percentage or an amount taken from gross production. Then there is the international and regular corporate income tax, about which there is so much controversy these days. That is a regular tax on returns to equity, allows capital to be depreciated, and it allows income to be deducted. In other words, its tax base is the same. It looks at the perspective from the point of view of the shareholders of the company. Then, and much more important these days, we have explicit taxes different from the first three that are imposed on what we might call the rent. the surplus from mineral or oil production. And those have occurred in many countries in different forms. And indeed, the core forms of production sharing in oil represent additional mineral or rent taxes, even if they incorporate the other taxes too. And finally, we may use state participation as an instrument of its own, for example, as a wish to take a share so that a share of dividends accrue to the state. Now, these instruments range very widely. And I think while this is here for the record, I have described their principal features. Now, today, we were asked to discuss royalty to some extent. Royalty has many benefits and many issues. It's known, of course, that it changes the path of extraction and thus may change exploration decisions. But you may actually wish to have that happen. You may wish to control the extraction path by making sure that only really profitable projects go ahead. And you may take the view that it really isn't worth the bother of extracting minerals unless you get something from it from day one. So those are good basic issues to discuss about royalty. The corporate income tax, I think we have covered there. Now, the explicit rent taxes may not be distorting of decisions in principle, but they do have so many forms, and they too become controversial. Production sharing has been much more common in oil and gas than in mining, though it is growing. And really, it had its origins in a nationalistic idea in the mid-1960s that for a government to receive production and sell it itself was somehow better than asking the corporation to sell it and hand over taxes. I'm not sure that that has proved necessarily to be the case, but it's still there. State participation, we mentioned, it can help resolve the issue of asymmetric information by ensuring that the government owns a repository of expertise and knowledge. But on the other hand, it can bring about severe potential governance issues because a large portion of revenue accrues to the company instead of to the Treasury in the first place. We need obviously to evaluate. And I'll refer to some literature here and not spend a very long time, but I'm sure, as everyone at the Minerals Commission in Ghana knows, it's possible to do it in one of two ways. You can model the effects of the fiscal regime on exploration, development, and extraction. That is, if you like, a kind of incentive approach. Or more commonly, you can go in for scenario analysis. You take a fixed project and you apply a fiscal regime and a set of assumptions to it. That's the kind of scheme that the IMF put together in its FARI system. And then you derive indicators to help you measure what the output of the fiscal regime is and how it compares. It's important, I think, whichever way we go, to have a project-specific approach. We need to start in some way from project economics, apply a fiscal regime, and then derive indicators. If we need a sector model as a whole, then we aggregate from different projects. Now, here's just an illustration of how this appears. This is what, if you like, the government take. This is the average effective tax rate under a particular oil project with about 1 billion barrels, an oil price of $55 a barrel, and a gas price of $2 per British thermal unit. And we put in here a basic share in blue that's going to the state, an increment for state participation, and an increment if we are changing the discount rate. We will see there that there is a very, very wide range of results, which indicates that there's no one appropriate government take. It's going to vary with circumstances. And as our Norwegian friends would say, a diagram like this doesn't really show you how the risk is apportioned, whether the revenue is coming sooner or coming later. Now, where does this all lead? Well, from that oil graph, we see that fiscal regimes for extractive industry vary very greatly. Similar simulations for mining suggest that government shares of 40 to 60% of net cash flow, that is an average effective tax rate, would be desirable measuring in advance. But of course, collection data will suggest, for a whole host of reasons, that what is collected is actually lower than that in practice. In petroleum, the simulated shares are higher, maybe 65 to 85% to government. And clearly, if we achieve shares below these ranges, we have a cause for concern or for regret. But we do need to remember that we have to ask what the government share actually means and what it includes. And this sort of analysis doesn't allow for the efficiency or inefficiency of revenue collection. It doesn't allow across one project for tax planning possibilities. So it needs to be treated with a good deal of care. Country circumstances will require tailored regimes, but generally within a framework that combines a royalty on gross revenue or a minimum production share for the various reasons we described, both economic and political, a tax targeted explicitly on rents and thus on the achieved results of extraction, a normal corporate income tax, though that's becoming less and less essential as the nature of the income tax in rich countries changes and the issue of tax credits becomes less important. And I think bonus bidding will have an important role in promising environments. So we note here that we're talking about a variety of instruments that may be used in combination. And what will that do? Well, it will ensure revenue from day one. It will share the risk. And it will ensure that the government does better as rents increase, whether from rising prices or from favorable geological and cost conditions. We do need transparent rules and contracts to promote stability and credibility, but we may still need provisions on the revision of agreements. I have put some material in here which will remain on points about administration, but that's not our principal subject. So I won't spend time on those now, recognizing their enormous importance. And there's a range of continuing challenges that everyone on this call, I think, will know about. I'd just like to add that there's a certain amount of literature that I've been involved in, and indeed Dundee has been involved in, particularly the one in the middle. These are all books in publication and all things that we use in courses at Dundee, which help us along. And with that, I'd like to say thank you for taking part, and I look forward to other contributions. Kofi, back to you.
Thank you very much, Prof. Daniel. One thing I've always admired about you is your patience and the ease with which you use to break down issues bordering around tax and revenue management. We are really grateful for the presentation. As we wait for more questions, my first question is going to border around what in your experience what in your experience is the biggest issue for extractive industry countries? We spoke about exhaustibility, and that will lead me to sustainability and sustainable development. So if we know that the resource is exhaustible and we want to maximize revenue, how then, what is the biggest challenge for resource-rich countries? Is it going to be a fiscal regime, or you would, in your experience and opinion, would it going to be in terms of revenue management? That's going to be the first question, and then after we can move on.
I think you raised the right question between those two. I've obviously specialized over much of my career in fiscal regimes, but I wouldn't say that's the biggest single issue overall. Of course, it's important to get those right. But I think the biggest single matter all around is managing expectations about what the population will get, both in advantages and disadvantages, from the development of extractive industries. We can see so much difficulty in many countries where perhaps the governance, for various reasons, historically has been weak, where it is extremely difficult, first of all, to manage expectations about what is coming out of existing producers. And of course, the example of Nigeria is so often used. But we've also had the problem in recent years, which has afflicted, for example, Ghana, and certainly afflicted the East African countries, is managing expectations about what's to come. What my friends in the Natural Resource Governance Institute call the pre-source curse. In other words, you think a big project is developing, and therefore you're expecting you're going to get a lot. And you even get riots about the siting of facilities before a single ounce has come out of the ground. So the whole question of managing expectations and putting in a framework for that, I would say that's your biggest issue.
I've had a resource case in a while, but yeah, in terms of managing expectation, I think it's a real issue because the minute countries discover oil or discover mining projects, it's sort of looked at as the whole economy of the country is going to change. And it's going to be sort of a blessing at once. And people don't really understand how the project grows and how the project actually starts to accrue funds. So I think, yeah, what you said is very right. Hakan has asked a very important question, which I think he was one of examples of countries that do not have any royalty and any experience or learning from them.
Clear experience, countries with no royalty. Currently, the three obvious ones are Norway, the United Kingdom, and Australia as far as offshore oil is concerned. Now, that is all in the case of petroleum. And in all cases, they made a change away from royalty after their industries had become to some extent mature. And they felt they had a portfolio of projects and therefore didn't need the particular revenue assurance that the royalty provided. They also took the view that in the long term, it was economically more efficient to do that. But those are the main examples. There are countries, particularly in what were formerly socialist countries, that didn't have the name royalty, but quite often had devices that amounted to the same thing. So that was the experience. And I think the reason that those three managed successfully without it was because they had already developed a diversified portfolio of projects and were then aiming to move to a different stage of efficiency in managing the resource.
I'd ask a follow-up question. So does it mean, did they increase state participation in any way when they decided to do away with royalties, or they didn't increase state participation in the project?
No, I don't think there was a matter of changing participation. In fact, in the UK, it was quite the opposite. The UK abolished royalty in the offshore at the same time as it privatized its national oil corporation. Norway abolished its royalty a bit earlier than it changed the structure of Statoil. But as you know, it kept Statoil, but Statoil is purely arm's length from the government now. Okay. The state in Norway does take what is called a direct financial interest, but that has much more the character of a tax and subsidy arrangement than state participation as originally understood. Australia has never had either state mining or state oil corporations. But you're right that there was always a state interest of some kind in the product of the industry. And participants may be interested to know that as far as Western Australia is concerned, where iron ore is a big industry, agreements over royalties and royalty management are public documents made with each license holder and published on the West Australian government's website.
That means that they are very transparent.
Mm.
Yeah. In recent times, most investors look at corporate social responsibility as a cost. And I don't know what is your view on it. Because when they decide on what mining projects to partake in, they consider what kind of investment they are going to make in relation to corporate social responsibility in light of the recent environmental, social, and governance matters that have become very paramount in decision making. And I'd want to know your opinion on that.
I think the opinion is unfortunately going to differ slightly whether you look at it from a government perspective or from a corporate perspective.
Government first.
Well, if I'm advising a government, I would take a fairly firm view that corporations doing voluntary corporate social responsibility of work of their own are doing something which is essential for them to do and is part of their international corporate overheads. And that's not necessarily a matter eligible for example, tax deduction in the country of operation, but that depends on the laws that are there. What I do think, however, is that if we turn it round slightly and we say the government imposes obligations of this nature on a company, which are in the development plan and therefore become an obligatory cost of doing business, almost like paying a royalty or something, then I think it's perfectly reasonable for that to be put in place and also for that to prove to be tax deductible. So there's an answer from two perspectives. I do think actually that's a fairly clear view. So you then have a negotiation, if necessary, in the course of dealing with a development plan, which both contractual and tax and royalty regimes would use. You then have a negotiation about what are compulsory activities, and that's perfectly reasonable, and that's going to change with political, social, and technical circumstances over time.
Thank you very much. Professor Dr. Adam Abukari has asked a question. The question says, can you provide a suitable mix of fiscal instruments that should be used in the frontier market?
I think they're not different from the range that are in the presentation. I think they are the same, but the parameters of them may change, because that will depend whether the government and the national oil company wants to offer a particular range of incentives to new capital to come in. So I think you can use those range of instruments, but the numbers in them may depend quite a deal on what it is you are trying to promote.
Thank you very much. Hakan has come again, and it's a follow-up on his royalty question. He says, what about when the state does not own the resources? Think about US. What implications does it have on the setup of the fiscal regime?
Dead right, and a very good point, because that is exactly the case. And interestingly, until the early 1990s and the reformed mineral law, that was also the case in South Africa. There was significant private ownership of mineral rights. And in my own country, in the UK, there is still, in the case of onshore hard rock minerals, some private ownership of resources. And in that case, clearly, the royalty right resides with the property owner. Now, the United States, in its offshore oil, continued that pattern, but under state ownership. So it treats the offshore continental shelf as public federal property and charges a royalty. It holds an auction with bonuses to allocate the areas. and it imposes corporate income tax. And that is a perfectly good model that has served them reasonably well. I think it served them less well onshore, where there's been a good deal of complication about royalty negotiations between private parties, how the individual states or the federal government have imposed royalty, and they've had a lot of collection issues. That's not a single point answer, but introduces some of the considerations there.
Thank you very much. My next question is going to be in relation to attracting FDI, foreign direct investments. Should a mineral resource-rich country focus on making their fiscal regime more attractive, or they should actually focus on other factors like stable democracy, a robust legal system, and those other factors, or it should always be about the fiscal regime? Is that of paramount interest to the investor?
I think the implication of your question, Kofi, is quite right. Of course, it is not the only thing that people have. Years ago, I used to put up a slide in which I would ask the question, what are investors looking for? And there are a list of about 10 things. And the fiscal regime came some way down. But I seem to remember that number one said, is there anything there? Right? That was number one.
Yeah.
And the number 10, the last one, was who is going to sue us? And you ran through a whole list. And you had to work these there. So you started, is there anything there? Can we dig it out? You know, can we move it about? Can we sell it? And so forth. So you're quite right. All those other things are absolutely vital. But clearly you don't get anywhere, and that's very clear in both sides of extractive industry, whether it's mining or petroleum. The first thing that capital is interested in is the nature of the resource.
Fair enough. Thank you very much. Lumon Amanda has asked a question. At what stage should an emerging mining country prepare to save mineral revenues, even most activities are at exploration stage? Said, at what stage should an emerging mining country prepare to save mineral revenues, even if most activities are at the exploration stage? Sorry,
was it what stage prepare to save?
So yeah, I think the question is trying to say that at what stage should a mining country or an extractive country decide that they are going to start saving the revenues that are being accrued from their mining projects, if that is even if most activities are at the exploration stage.
I understand.
So maybe it's a greenfield kind of country where most of the projects are at exploration stage.
And you'll see over my left shoulder is a flag.
Yeah.
And that is the flag of Timor-Leste, East Timor.
Okay. Yeah.
Which faced exactly the situation your questioner is asking.
Yeah,
because they came to the referendum about leaving Indonesia and becoming a sovereign state. But at that time, there was a serious possibility of coming to a major petroleum project. So they had to face exactly this question. And I think they answered it quite satisfactorily, is that we talked earlier about managing expectations and the so-called pre-source curse. In other words, not resource curse, but pre-source curse.
Okay.
Yeah. Because I think to start raising expectations during the exploration that there's going to be a bonanza is actually a political mistake. It's not necessarily an economic question. It's a political mistake. And what happened in East Timor was that they did not do anything about starting to establish funds and that sort of thing until there was first, in effect, a final investment decision about the project that they expected to yield the revenue. Before that, they'd done quite a lot of investigation of what were the possibilities and quite a lot of projection work on what the returns might be. Because until you know that there's going to be something worth saving from, an awful lot of effort can be wasted in designing funds of one sort or another. And Kofi, I believe you and your colleagues with the Ghana experience may well be able to tell a salutary tale about all of that. And I would withhold a bit. So I would say, using a savings device or a fund is at best only a support mechanism for good revenue management. The fundamental decisions about managing the sector and managing the public finance are prior and much more important. And if you are going to go that route, know that it has some realistic possibility of being useful, and know that these projects are actually going to go ahead, because it is really quite extraordinary how much time in some places, and I would withhold from mentioning them, has been of skilled officials, time of skilled officials, has been diverted away from negotiating with the providers of capital and into satisfying political demands for how such a savings fund, which, remember, at that time has nothing in it at all, into negotiating how that eventually is going to be distributed. And it seems to me that that's the wrong priority for scarce skills.
Thank you very much. We'll be running up shortly. Our time is fast spent. I'll just take the final question and then we'll round up. Hakan again, he says, on fiscal regimes and contracts, do you have any advice or thoughts on this? It seems to him that and others that contracts to a certain extent undermines attempts to set up a balanced fiscal regime.
Do I understand here that the question is asking whether a contractual system actually does better in setting up a balanced fiscal regime?
Yeah.
Well, I would say sometimes it does, but not necessarily. And by and large, you will see that contractual schemes have been used in countries either where the sector is not as mature as it is, say, or was in, say, Australia or somewhere like that, or where there are issues, maybe there's been past conflict or whatever there has been, where the legal regime and the regulatory environment is not as well developed as it is in other places. And the advantage in those circumstances of a contractual regime is that from the point of view of both the government and the companies, you can pretty much put everything you need in one place, in one document, rather than having to ensure that all legislation is in place. Now, my own feeling about that is that it is better, in fact, even if you use that to begin with, to evolve towards a situation where general legislation, including tax legislation, is actually available to cover everything. And one of the things you can do with past contracts is learn from them with a view to making future legislation. So it really is a case of horses for courses, I think. And it's interesting that the mature provinces, by and large, there are exceptions, but the mature provinces, by and large, have moved to circumstances of general legislation rather than a contractual system.
Thank you very much, Professor Philip Daniel. It's been a wonderful session, and we won't take much of your time again. To our participants out there, please do not hesitate to tell people about the Extractive Hub, and please do check out the website and to also watch it for further information. Thank you very much. And I'm going to hand over to Victoria.
Thank you very much, Kofi. And thank you very much, Professor Philip Daniel. You did a very great job and we've enjoyed the webinar. And for our participants, because we had many people who had registered for this webinar also previously, they had registered, but I think due to the time frame and other commitments, they've not been able to show up, but we shall be able to share with them the recorded video and also the slides. Thank you very much, Kofi, and thank you very much, Philip, for this excellent seminar. And I think this marks the end of our webinar. Stay tuned and yeah, have a lovely time and stay safe.